Berger Weiner is a financial services firm experienced in all aspects of investment and retirement planning. Here to tell us about what they offer and what you should do to prepare yourself is Howard Pressman, a certified financial planner at Egan, Berger Weiner. And you guys always make it so easy for us to understand these very scary things. Now, today we're going to be talking about bonds and especially what's happened since 2008. Take us back and tell us where we are now.
Well, Sonia, a lot has happened in 2008, and it certainly looms large in the minds of investors. Primarily, it seems that investors have really exited stocks altogether. This is evidenced by the fact that there have been net flows out of stock mutual funds every quarter since 2007. Now, at the same time, investors have been pouring money into bond funds to the tune of about $1.4 trillion. Wow. Yeah, so they're not being specifically balanced in their approach, and that's a big change. And I presume that this was done in efforts to be safe. And while it may appear safe, they really are opening themselves up to different types of risk.
And so there is a lot of danger. What are the dangers in that type of behavior?
Well, primarily the danger revolves around being unbalanced in your approach. Bond prices react negatively to changes in interest rates. So as interest rates go up, bond prices are going to come down. And that's a real problem for people who are severely overweighted towards bonds. So without getting too much into the weeds here, there are two factors that primarily drive the prices of bonds, and that's going to be the ability of the issuer of the bond to pay you back your money and changes in interest rates. So again, as interest rates rise, the dollar value of existing bonds will come down. And I think we've got a couple of charts here that show just over the last 3 months the rise in the rate of the 10-year U.S. Treasury bond. Over this same time period, we can see a corresponding decline in the price value of bonds. And this is likely to accelerate. I fear that we're in the initial stages, or the first innings, if you will, of a general rise in interest rates. And we've really seen this pick up steam since Wednesday, when the Federal Reserve Bank came out with their statement. And bonds hit, or at least the 10-year U.S. Treasury bond hit a 22-month high on the 10-year bond just yesterday.
Okay. So you can actually lose money on bonds.
Absolutely. If you buy a bond, an individual bond, and you hold it to its maturity, you're going to get back the money that you put in there. However, if you are forced to sell that bond prior to maturity, you're going to get whatever the market's willing to pay you.
So what's the better approach?
The better approach, Sonia, is to always stay diversified. And at Egan, Berger Weiner, we're big proponents of being broadly diversified. And what that means is spreading your money out over a number of different types of investments. You want to have bonds in your portfolio, and I'm not saying you shouldn't have bonds in your portfolio, because they really do protect you in the event that there's a recession. They'll protect you from broad stock market sell-offs. They'll help to iron out the volatility that a more stock portfolio might have. But you also have to have stocks in your portfolio. It's very important, because stocks give you the best opportunity for future appreciation. As well, they will protect you in the event of rising interest rates, and certainly from inflation. Now, the challenging part, however, is to determine how much of my money belongs in stocks versus bonds. And that's a very individual situation that really depends on the individual investor. What is your time frame? What is your tolerance for risk? What are your goals? And what's your current financial situation?
And very quickly, just to wrap up, how can we protect ourselves if we do have bonds?
The first thing you have to do is understand what types of bonds you own. Because so this is a case of not all bonds being created equal. Not all bonds are going to respond to rising interest rates the same. Some will weather this storm better than others. So the first thing investors need to do is understand what bonds they own. If they own it outright or they own it in a mutual fund, understand what you own and how sensitive it is to changes in interest rates. And if you find that you're over-allocated to bonds in general, or that your bonds are very interest rate sensitive, now's the time to make that fix.
And if we can't understand it, we should just go to a professional like yourself, right?
Always go to a professional.
Okay. Thank you so much, Howard Pressman from Egan, Berger Weiner, LLC, for always explaining things to us and make it seem easy. Thanks so much for joining us.
Thank you, Sonia. It's my pleasure.
More Let's Talk Live's coming up. Stick with us right here.